Thank God it's Friday. That common refrain is now BloombergQuint's opportunity to look at the markets in the week that has been and gaze into the crystal ball and understand where markets will be here on. To do that and to debut this column, we have with us very well-known investor in India, Ramesh Damani. Mr. Damani, thank you so much for speaking to BloombergQuint.
Menaka, always a pleasure, and so Friday is always fun.
Well, absolutely. I'm going to start by asking you about a not so fun topic, and that is earnings. We've seen a couple of major banks come out with their numbers. We've seen some of the top IT companies come out with their numbers, as we have seen with FMCG and a few other companies. As you stand today, how are you taking stock of what has happened in the Indian economy in the last few weeks and what the earnings season is turning out to be?
Well, the last few weeks have, since Brexit happened, the market has demonstrated its almost incredible strength. The bull market was in full form, conquering those walls of worries, if you call Brexit, and perhaps even the earnings season. I mean, it was always on the cards that the earnings would rebound in a few quarters later. And I think this is the first quarter that the market will hold a litmus test. I think, yes, some tech earnings have been weak, but on the other hand, consumption companies will be very good, cement companies will be good, infrastructure will be good. A lot of the pharma companies have come out with very strong numbers. So it might be a mixed bag. I can't say on an aggregate level, but I think individual companies like oil marketing companies, for example, are showing exemplary earnings growth. So overall, I tend to be very optimistic, not only about last week, but about the last few months on the Indian stock market.
All right, let me try and see if this optimism will last, Mr. Damani. Given where you sit today, in terms of your conviction in this bull market over the last several years or last couple of years, what would you identify as the key opportunities and challenges facing India, not just as an individual economy, but in the context of what's gone on in the global economy? So if you were to list for me some of the key things that you use as parameters to decide whether you continue to stay bullish or whether the sentiment is turning.
Well, Menaka, the first thing we tend to look at is the overall direction of the market. I think the market made a very important bottom in August 2013, about 8 months before the Modi government was actually sworn in, when the rupee hit 70 and Chidambaram and the finance ministry were in panic at that time. I think the market hit a bottom. Since then, it's been 3 years into probably a much longer bull market, and every indication is that the bull market has a long way to go. Now, the other question, of course, people ask is what about global events that take place? But here you have in the world, 1/3 of the bond portfolio of the world probably trading at negative yields. Whether it's in Germany, whether it's in Denmark, whether it's in Switzerland, or whether it's in, so many other countries. Whereas in India, you have positive real interest rates. You have oil prices going down. You have a government bent on reform. And I think the reform is taking shape. If you step back and look, you can see the tile instead of the mosaic. You can see the forest for the trees. And I think there's reason to be optimistic. I think that the Indian economic reform process, the Indian GDP number will accelerate in the coming months, along with it, of course, corporate earnings. So I think if you look at a globe that is starved for growth, you're finding growth in India. In India, again, you're finding costs are coming down, profits are rising, margins are healthy. So, my feel is that we're in a pretty nice sweet spot right now in the global financial picture.
Mr. Damani, I just want to talk about that continuing optimism that you expressed in the Indian bull run. And it's not just you. Several other well-known, renowned investors have felt that way. In fact, one of them has called this or expected this to be the mother of all bull runs. But we have had times that have tested that hypothesis, whether it was the beginning of this year or it was the fears in the run-up to the Brexit vote, or now it is the nervousness around when an FOMC rate decision will come in, or even some commentary coming in on Indian markets and their valuations. How do you look at some of these negatives or threats, however you may want to term them?
Good question, Menaka. We're opening up Pandora's box of the different problems that the market can face over the next 6 months. FOMC, China devaluation, a whole bunch of things can affect the market, global terrorism, among other things. But my view is that the market is up year to date and is very close to its all-time highs, despite a very weak January, February, despite Brexit. So what the bull market is showing, that it can climb the walls of worries. I think the one key global event that would worry the market, of course, is if the FOMC decides to raise rates. The markets can deal with any subject almost except for rising interest rates, because that would change the valuation of all equities across the world. And the market is now on steroids. It wants low interest rates. So if that happens, it's unlikely to happen this year, then of course, the market would have to grapple with higher interest rates. So that would be the key risk, along with, of course, continuing bout of terrorism that we've seen in the market. Other than that, it seems that the market, whether globally, even as I speak to you today, Menaka, the 10th stock on the Dow yields 3% dividend yield. 3% dividend yield in dollar terms in a market that is in negative interest rates. So that's not a bad place to be, which is, of course, the equity markets. Now, the question that you asked was, this is the mother of all bull markets? Is that what you're saying? I have noticed in history that every bull market is greater than the preceding bull market. So the 2000 bull market was greater than the 92 bull market. The 2003 was greater than the 2000. And this bull market will be greater than the 2003. In terms of magnitude, points, distance, time, every bull market tends to be more powerful than the previous one. So I'm crossing my fingers and I'm hoping we're right this time too. Last time we had a bull market, the index went from 3,000 to almost 20,000, which is almost a 6 to 7x move. We bottomed out at 16,000. So I'm not making any prediction, but my logic suggests that there's still a ways to go in this bull market.
How would you quantify those words, a ways to go in this bull market?
I think we typically bull markets might last 5 years, 7 years. We don't know that. I'm not putting a time frame to it. But there's very clear evidence that will suggest that a bull market is stopping out. The panwala will start giving you tip. That's the proverbial thing to look for. The IPO market, there'll be a lot of leverage position in the market. A lot of bad quality companies will start trading and going up every day in the high trade. There are no signs right now. Indians are just beginning the romance with equities. They're just opening the demat accounts, applying to IPOs, subscribing to shares. So, my sense is that as long as India maintains this trajectory of 8% growth in a world awash in liquidity, money is going to come into equities. And if you find those great businesses, it's still a very, very happening place to be.
In other words, you're saying there's considerable upside to this market. And what I'm trying to get from you is how you would quantify that upside. So is there anything in percentage terms that you can give us as an indication of your assessment of how much further higher this market could go?
Well, Menaka, if I can use the meme of the times, and I'm using it with a sense of humor, so please understand that. When I was asked this at a conference, where is the Sensex headed? I said, to quote our Prime Minister, Afki baar, Sensex 50,000. Let's start with a round number. Let's hope we get there. I am hopeful. But of course, don't put your money on where my mouth is.
Well, are you suggesting, and I know you warned me that this was with humor, but you can't really be saying 50,000, right?
No, you see, bull markets, the trajectory of bull markets suggests that the index, typically doubles before it peaks the history of bull market. For example, let's take the 92 bull market that culminated at 4,500. But what people don't remember that it started at 8,800. Or the 2003 bull market that started at 3,000, that finished at 20,000. You can do the math. Your readers can do the math. Bull markets have a long way to go in terms of magnitude. So I think we'll be surprised by what develops. Each bull market, Menaka, tells a story. The 2000 bull market suggested that India was going to be a technological superpower. Well, that has happened, hasn't it? So each bull market is a story. It is up to individual investors to find the story, to place their bets accordingly, and see where the chips land. So I remain optimistic. The 50,000 is set in a moment of levity, but I think it's time as any to get into the retail market. Just because the index has gone from 16,000 to, say, 28,000, it doesn't mean that the bull market is nearing its end. In fact, I think it's just well on its way.
Okay, fair enough. You flagged off one big concern amongst many others, and that was a rate decision or a rate hike by the Federal Reserve. Now, whether it happens this year or next, it could mean a substantial correction in our markets. Have you been able to assess really what it will mean in terms of foreign portfolio outflow, and therefore what kind of weakness we'd be exposed to?
It's actually too far crystal ball gazing. We'll deal with it when it happens. Whether the global economy is strong or weak, then what will oil prices be out there? We'll have to decide at that time. But from the past experiences of the last few years, the one thing that the market is not ready to face, it's ready to face almost anything. What happened in the CAC Koran the day terrorist attacks happened in France? It closed higher. Market, can go through Brexit, terrorist hikes, almost anything it's able to handle in its stride. The one thing that I find that the market still does not have the ability to handle is significantly higher FOMC rates. So if the Fed starts signaling they're aggressively going to raise rates now because there's inflation returning to the economy or because they feel that interest rates are too low, that would be a warning sign that the bull market may be coming to an end. As of now, I think the guidance is that at least for the next 6 months, we're not going to see any. So, why, pray for an early death? Let's watch and wait.
All right, fair enough. I know that you don't usually talk stock specific or give or offer stock specific commentary, but given where we are today, I'm going to ask you about a few sectors and see if you're still interested in them or whether your investment strategy has changed in the recent past. And you may comment as you please on these. So, for instance, we've seen banks on the one hand, especially government-owned banks, faced by big bad loan problems, and on the other, some might say that some of these banks are available at very, very cheap valuations. How are you looking at the sector, especially government-owned banks? And if I was to extend that to the financial sector and let's say NBFCs or microfinance institutions, do any of those investment opportunities interest you?
The financial sector, the public sector financial sector has always been a cause of concern to market men who've been studying the balance sheet. It makes little sense to me that, say, 6 months ago, these companies were, paying 30% tax rate and a high dividend rate, but not making the provision. So they're basically paying out profits and tax on money they didn't have. So now that they're recognizing the reality and taking the write-offs, the stocks have been in the depression. Are they cheap enough to buy? Not until I see a culture change coming to these PSUs. I think we need a culture change, not necessarily just a balance sheet change. We need to make sure this problem won't reoccur. So to summarize, I probably wouldn't be looking at them at this point.
Okay, what about sectors like IT, FMCG, industrials? Has your viewpoint on these sectors changed, let's say, in the last few weeks? And what will your investment strategy be here on?
Well, with the IT sector in particular, I have a slightly nuanced view, Menaka. It's been a long-time favorite of bulls on the Wall Street. We've all, cut our teeth with companies like Infosys, Wipro, TCS that have gone up 50x, 100x, made us a lot of money. So we're always enthralled with these companies. They continue to do well. But those companies pioneered a service-led, business-oriented model in India, which essentially means you export services to the West, $1 billion, collect in rupees, bill your expenses in rupees, collect in dollars, and make the margin. And because the rupee depreciated and the volumes were growing, you kept doing well. That model may be under threat due to automation, due to competition, and just due to the fact that there's a slowdown in the global IT spend. But increasingly, I find, as an analyst, there are a lot of opportunities in what I call the product-oriented companies out of the Wall Street. There are a lot of companies that are trading now to vertical markets, building products in knowledge, database, antivirus. I think they offer some very attractive opportunities for investors. They're available at fairly cheap valuations. So rather than look at the old services-led model, which of course I have in my portfolio, I would also be looking at the product-oriented companies. I think there may be half a dozen on the Wall Street now that have exciting balance sheets, exciting prospects, and probably deserve a little bit of investor attention. So that's my short take on technology.
Fair enough. I think this is something similar to what you said in 2015 as well. And at that time, if our research is correct, you were interested in companies or already invested in companies such as Polaris, Geometric, Sonata, Nucleus. Now, I'm not asking you if those are still in your portfolio. Are you still adding to that kind of investment, which is the product-oriented IT investment?
There has been more plethora of offerings in the last. Polaris spun off a nice-looking product company,
Correct, yes.
Which I own. There's a lot of other few companies that come out with IPO recently. So it requires a little bit of digging. The road to riches is never easy. So there is risk in these stocks because the unproven business models yet. We don't know if India can legally sell in the domestic market a lot of licenses or is it all going to be pirated software. So time will tell. But I'm fairly excited about the companies because they address very good opportunities. For example, the Aadhaar database was built by an Indian company. That's a huge technological achievement. They have 100 crore people on a database. Antivirus software companies are showing up in India. So that, makes me excited as a technology investor.
Fair enough. We've had a decent monsoon so far. Would you say that that means that there is hope for, some sort of rebound in rural consumption, and therefore your outlook on, let's say, consumer stocks is going to improve from here on?
Definitely, we absolutely needed a good monsoon. Otherwise, this bull market would have been derailed fairly badly. I think there's a consumption boom going on in this country, hidden behind the numbers in terms of sales at say department stores, tractor sales. I think there's a very strong consumption boom going on in this country, which will show up in the next few quarters of earnings. So I remain fairly bullish on the FMCG space, Menaka.
What about industrials, Mr. Damani? Because that's again been a sort of beleaguered sector, a variety of issues that I won't get into right now. But are you seeing enough investment pick up for the industrial sector to show promise here on?
At sometimes you need direction from New Delhi, and I think we are getting it. If you look at how the government is going about the PSUs, using them as investment, some of the stocks have appreciated handsomely, starting on the strategic disinvestment roadmap. So they're doing a good job there. Now, the big bet that the market will have to make is that Indian manufacturing at 22-25% of GDP cannot become greater than that. And that is why the Prime Minister launched his Make in India scheme. Now, here's the point that I'd like to make, that this is a country that, if it puts its mind to, can send a Chandrayaan to the moon or launch a space shuttle. 5 countries in the world have that kind of technology capability to do this thing. UK, Russia, France, America, all right? China. We are doing the 6th country perhaps to do it. But at the same time, why can't we go to Cupertino instead of the Chandrayaan and tell Apple computers that we build the iPhone 5 out here? I think we start getting some of those orders for manufacturing. That will be manufacturing and a boom there. It's a long-term call, but I'm hopeful because at least it's in the eyes of the North Block and New Delhi.
Are you betting on a recovery in capital goods, in infrastructure, or do you still think that's about 6 months to a year out?
I think infrastructure is recovering. I think capital goods, some of the companies I follow are not showing anything in the balance sheet yet that they're recovering. But I think infrastructure in terms of defense, roads, I think they are well on the way to recovery.
Okay, a commodity upturn in sight, according to you? Metal companies are now a good buy?
I really avoid those companies. I don't have much knowledge of metal companies, but a sector that is, looking at becoming a darling of the market of the next 6 months, it's already done very well, but I think still has some steam left on the upside. It's probably the oil marketing companies. I think these are phenomenal companies that have basically monopolistic businesses. India is now the largest volume importer of oil in the world. So the swing buyer of oil. Prices are deregulated. Governments have announced bonus and liberal dividends for these companies. So I think they're catching market fancy. And the valuations will probably go from single-digit P's to double-digit over the next few years.
All right. My last 2 questions. Mid caps and small caps versus large cap stocks. What would you prefer today?
I think what I always say, Menaka, my 2 criteria for buying stocks are not whether they're mid-cap or large-cap. First criteria, there must be a great business, whether it is a product business, as I mentioned earlier, that excites me, or a consumer business like, say, a behemoth like Lever that excites you. You want to buy it cheap. There's no substitute for buying these stocks cheap. It is your understanding as an analyst to understand the valuation that the market is offering. Often large-cap stocks can be stunningly cheap in terms of the potential over the next few years. So you buy it cheap, and you don't necessarily worry too much about the large cap, small cap. Of course, typically the great stocks happen to be the small cap stocks, which are unnoticed, which go on to become large caps. So hopefully we'll find a few of those before the bull market gets over. But the greater idea is to find greater businesses. That is what the focus is.
Fair enough. And then my last question, Mr. Damani, is this. What would you identify as the one big change in your investment strategy in the last few weeks or months? I'll leave the time frame open to you. But maybe some revelation about a company or a sector or just a strategy point of view that you think has maybe influenced or changed the way you put your money to work?
That's a probing question. And I ask that question all the time, Menaka, because ultimately when you run your own money as I do, your prop money, you're answerable to yourself, and you can take the lazy route out, for example, and say, oh, I've done well, so I don't have to worry. And I think if I ask myself, I always fall short on that regard, because say the opportunity was to earn 100 rupees in the marketplace, and you earn only 40. you're still under-delivering, even though you've probably done well for yourself. So the question is, how do you beat under-delivery in a market that is so promising and so chock full of opportunities? I think one lesson I've learned, and which I try to teach the young kids who come through my office, the newer analysts in my office, is that when you find a great business or a great company at a valuation that is striking, you don't get rich by buying a few thousand shares or a small amount of your money in there. You need to back up the truck and make a large equity allocation to that particular investment idea. It's difficult to implement in reality, but all the greats do it. I think so. If I want to teach myself one thing, is how to put bigger sums of money in a more concentrated bet once I'm convinced about the idea.
So, what was your biggest recent bet, Mr. Damani, if I may ask you that? One that we don't already know about.
I think the one that will surprise market people is these product companies that I'm buying, which are in the software space. I think they are very young companies. I feel as excited about them as I felt in '92 when we bought the Infosys and Wipros at these valuations. At that time, the Wall Street was all about cement companies and iron and steel companies, and no one understood software. I think now, of course, there's a better understanding of software, and these companies have done very well. They compounded over 20-25% over 20-25-year periods. So they're done fabulously well for investors. But I think the road to riches in technology companies perhaps lies in these smaller micro-cap companies that are doing exciting products. Like Intuit, for example, did in the United States with accounting software, Tencent in China. I think the Indian entrepreneurs are now de-risking from the services model, moving to the product model. And that in itself will offer us some exciting opportunities.
I'll leave it there for this Friday then, Mr. Damani. Thank you so much for being on this debut edition of Thank God It's Friday. And thank you from the BloombergQuint team.